Hello and welcome back. You are listening to the Roundtable Real Estate Simplified. I'm your host, Emilio Estevez, your real estate expert, and we are here with our co-host, Zachary Levesque, your financial and mortgage expert. And Zachary is actually going to talk about how much interest rates affect your mortgage payments. It's big.
Yeah, it is big. Thank you for the intro, Emilio.
This is never going to end. Zach, can you tell our audience where?
I'm sorry.
Where does that come from?
All right. Well, it doesn't just come from our warped minds, Emilio. It's actually from a movie. Some listeners might remember it, some might not. For you fans of comedy, it's a Will Ferrell classic, Night at the Roxbury. Him and his brother were conversing about meeting Emilio Estevez.
Yes.
And I believe one of them screamed that ridiculous. Emilio! Yeah, there it is. So everybody listeing, I'm sure you know what Emilio looks like. Hopefully, if you see him out, you really got to just get right in his face and just say that. Okay?
Oh, man. Thanks, Zach.
All right, let's get a little more serious. Yeah, so the Mortgage Matters section this week, I really wanted to talk about interest rates and how they do affect mortgage payments, and also get into what drives interest rates up or down. I think it's important for the listeners to know that. And by knowing what factors contribute to it, they can also research themselves and stay in touch with the market. Because interest rates just moving a quarter, a half of a point, these represent large differences in payments, and they can affect home buyers, certainly. So just to give everybody a brief recap of where interest rates are currently, conforming 30-year rates are at 3.75%. Low.
Unbelievable.
FHA rates, government loans, purchase refi, 30-year fixed rate, 3.25%.
Zach, can I just interrupt real quick here?
Absolutely.
The average rate over the past 40 years was 8.9%.
That's insane.
Right?
Absolutely. Absolutely. And you don't want to know what those mortgage payments look like at 8%.
No.
When you hear how much a mortgage payment changes with a 0.5% increase, 8 is people would be buying houses for half the amount, with that interest rate increase. The 30-year rates are back at historic lows, which were in March of 2013. That was the lowest point of interest rates ever on record. And we're right back there again. Many people, economists, forecasters, did not expect this to happen, but it has. So we're back into another pocket of refinancing ability for current homeowners, and also people that are still on the fence to purchase. And I hate to say it, it's redundant, but if you're in the market and you're thinking about doing it, if you really are confident that you will in the next couple of years, you got to do it soon, because we're going to be experiencing interest rate increases and property value increases. So if property values go up 10% and interest rates go up 15%, not to 15%, but from 3.7 to 4.7, if that happens, mortgage payments will be 30% higher than they are today. And that could be one less bedroom, 500 less square feet, a different town for your children if they go to school.
That's a good point.
And education's important. So the interest rates are move with the 10-year bond. So long-term interest rates are based upon pricing on a 10-year bond. You can go on any financial website. I usually use yahoo.com. Go to the financial tab, and it always gives market 30-year rates, market 15-year rates, but pay attention to the 10-year treasury bond. If the 10-year bond goes up, rates go up. If the 10-year bonds go down, rates go down. Currently today, the 10-year bond is down 2% at 1.77. And when rates were at historic lows in 2013, it was right around 1.6. So we are right there to where we were before. So feeding frenzy should be taking place.
Yeah, it is, actually.
Yeah, it definitely is and listeners, if you're buying a house, or even if you've been considering refinancing, the time might be now to do that, for a term reduction or for an interest rate reduction, or even taking cash out.
You know what I'm actually seeing in the past week or so, I've had people calling and looking to sell their homes and actually buy a new home.
Absolutely.
Smaller size. A lot of people are downsizing, but you've got a lot of people coming into the market and buying. So it's perfect, especially that $200,000 to $300,000 and $300,000 to $400,000 price ranges. That's what we're seeing move the fastest right now.
Yeah, and if I think you're seeing a lot of that activity because we did a segment last show on rent versus own.
Yes.
It's cheaper to own now
Yes.
in most cases. And you have
Crazy.
tax benefits to owning versus renting. And that's why there's so many investors buying homes and renting, because they're making so much money on renting the property out. They're covering their mortgage payment and more.
A ton.
Absolutely.
Definitely. So if you guys are just joining us, you're listening to the Roundtable Real Estate Simplified. I'm your host, Emilio DiSpirito, with the DiSpirito team at Prudential Gams Realty, and our co-host, Zachary Levesque with Maverick Funding.
All right, so I wanted to talk a little bit about, I mentioned the 10-year bond and the movement of that affects long-term interest rates. I just wanted to go over a couple factors that affect the bond. So what makes the bond move? Because once the bond moves, interest rates move. One of the factors is employment data. Employment is down month over month for the last couple of years, and Rhode Island had that unfortunate report that we were, I believe, the highest in the country for unemployment.
Yeah.
It's down below 10%, which is heading in the right direction, but still too high. Unemployment data affects a 10-year bond. Generally, if the news is bad, rates get better.
Yep.
You can always follow that rule. Not always, but most of the time. Stock market performance affects interest rates in the 10-year bond. Usually, if stocks are doing well, the bond goes down. But again, if anybody out there invests in the stock market, whenever you think you know something, you're proven wrong every day. So the stock market is very difficult to understand, and sometimes when you think one thing is going to happen, the opposite does. Health of the economy is a good indicator. If the economy is doing well and there's positive reports, jobs reports, GDP, gross domestic product, usually the 10-year bond would go up, forcing interest rates up. The Fed. Some people hate the Fed, some love it. There's a new Fed chief. And recently, the Fed tapered their bond purchasing program because the Fed was just buying up all the bonds, forcing and keeping rates low so that the secondary market didn't have to come in and do that. They've tapered that, and it's almost stagnant now. And that activity will start to force interest rates back up because they've tapered that bond buying.
Yeah, they have to.
Yeah, and that's how they artificially. It was an artificial market created by them because they knew nobody else was going to buy them, so they had to, which kept the rates low. And as things have been improving, there's not as much of a reason, and they're going to let the market correct. And finally, well, I already mentioned that the bad news means better rates. So it's not. We don't wish for bad news, obviously, but if it does occur, usually you can look at things improving in the interest rate market. And finally, we talk all about interest rates and how they affect payments. So I wanted to give a tangible representation of how a mortgage payment is affected by interest rate increases. So I basically took a $200,000 loan, and I'm going to give principal and interest payments because it's not a specific property that we know with taxes and insurance.
Okay.
So it's a mortgage payment based on principal and interest. A $200,000 mortgage loan based on a 30-year fixed at 3.75% is $926 per month. Probably a lot lower than people would think anyway. It's under $1,000 a month, not including taxes and insurance, to own a $200,000 house. Well, to take out a $200,000 mortgage.
Sure.
That payment, if you raise the interest rate by 1% to 4.75, increases $117 a month to $1,043.
It's quite a bit over the
It's
year.
a lot, and before you mentioned the 8% rate. You don't even want to know what 8% is at 200.
Do you have it?
I don't. But it's definitely over 1,400.
You'll get back at me in the lightning round.
When we talk about the time to buy is now, it might not be today, it might not be tomorrow, but things are improving in the country, in the economy. When rates do go up and when property values increase, borrowing costs will go up dramatically. And that's why we say that to the listeners.
All right, we actually have to cut to a quick commercial break, but when we get back, we're going to go over 7 ways to increase your home's value, and then we are going to have the lightning round. That's where Zach asks me a series of questions about mortgages, and I ask him a series of questions about real estate agency and property.
I hope you did your homework.
Oh, I did. I hope you did too. Stay tuned.